What's going on with crypto?
Well, the markets are holding steady and stable. I mean, overall, we've been recovering since 2022 in the FTX crisis, and it's going to take a little bit more time for it to clear out, but I'd rather be a crypto guy than a banker right now.
Welcome to Crypto Savvy. Before we delve into Cardano launching its first Hydra head and how its NFT is picking up momentum, Cardano, which Hoskinson created in 2016, has become the world's 7th largest cryptocurrency, with a market capitalization of $13 billion, compared to Bitcoin's $566 billion and Ethereum's $232 billion.
Really? Are people losing interest in crypto?
Crypto is okay. Banks, not so much.
Why? Tell me about the banks.
Well,
First Republic?
Yeah, 2008, we had $373 billion in tied up assets. I think we're over $540 billion now. Just in the 2023 crisis, we're just getting started. I mean, that whole business model is falling apart when you give it a little bit of a push and then you lose these institutions like SVB, and they get so politicized and they get so globalized and they kind of get pushed into different philosophies. So it's nice to be in crypto land where things are simple and pure and you can just focus on building.
In March, sudden deposit flight from Silicon Valley Bank and Signature Bank forced the Federal Reserve to step in with emergency measures. But panic spread to Switzerland's Credit Suisse, which had to be rescued by rival UBS. What's going to happen is too big to fail is just going to lead to bigger institutions, Hoskinson said. We've seen this story in 2008, and this is a rerun. I don't think anybody wants to watch it. The 2023 banking crisis has been partly triggered by the Fed's rapid series of interest rate hikes over the last year, with rates this week climbing to levels not seen since before 2008 in an attempt to rein in soaring inflation.
I don't know how simple it is because we're about to get new regulations, we think, and we're going to get new regulations for the banks. Is this the answer? I mean, Joe Biden just the other day said, look, we're going to make sure that we have tougher rules for the regionals and tougher rules for these smaller banks. Can you do a stroke, pardon me, for all of the banks, the same regulations for the global money centers than you do for the regionals?
No, you can't.
No, right?
And what's going to happen is too big to fail. It's just going to lead to bigger institutions. We've seen this story in 2008, and this is the rerun. And I don't think anybody wants to watch it, but, well, we elected the same people, and now we're dealing with the same consequences. I mean, if you widen the aperture for the global markets, though, people are moving on. The Europeans are moving on with MiCA, the Asians are moving on, and overall, the global regulatory environment for cryptocurrencies is getting better, especially in very competitive jurisdictions like the GCC.
The White House wants to slap a 30% tax on the electricity used in cryptocurrency mining. Why? Well, they say those crypto miners are consuming a ton of energy and causing some serious damage to the environment, local communities, and the power grids. To address this, they've come up with a fancy-sounding tax called the Digital Asset Mining Energy, or DAME, excise tax. The idea behind it is to make miners take responsibility for the negative impact they're having on society. But hold on, not everyone's on board with this plan. Critics are crying foul, claiming that the industry is being unfairly singled out. The tax would be rolled out over 3 years, starting at 10% and eventually hitting 30%. The White House argues that this tax is crucial for national regulation and to reflect the social cost of crypto mining. On the flip side, advocates of the crypto industry point out the benefits it brings to the unbanked and argue against unfairly targeting them. Anyway, enough about taxes for now. Recently, Cardano took a significant step towards improving its scalability and transaction speeds. The launch of the first Hydra head is expected to have a profound impact on Cardano's transactions per second, soaring from 250 to an impressive 1 million. This remarkable increase opens up vast possibilities for the network, captivating the attention of investors and developers alike. However, while Cardano continues to innovate and evolve, its holders have faced some setbacks. Negative sentiment has prevailed in the market, resulting in losses for ADA holders. Continuing our exploration of Cardano's growing presence, Cardano NFTs have gained momentum and are making their mark in the NFT market. While Ethereum and Solana have been dominant players, Cardano's entry into the space has brought unique advantages. Cardano's focus on sustainability, interoperability, and low fees sets it apart. It offers features like creating NFTs without smart contracts, minimal fees, and multiple asset transfers with a single transaction fee. the rise of Cardano NFTs presents an intriguing future for the digital collectibles market and provides a promising alternative to Ethereum and Solana. However, its success in surpassing the dominant platforms depends on factors such as network adoption, developer support, and user demand. Thank you for tuning in and joining the conversation. We appreciate your feedback, so please share your thoughts in the comments section below. In our next video, we'll explore the reason behind Warren Buffett's skepticism towards Bitcoin and delve into the potential risks associated with it. Don't miss out on this exciting discussion. Hit that notification bell so you'll be the first to know when our next video filled with valuable insights is released. Stay tuned.